You are listening to Uranium Spotlight on Tuesday, January 21st, 2025. Brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Uranium, and IsoEnergy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, Kazatomprom releases its new development plan. China reports more questionable discoveries. Ontario reveals ambitious nuclear plans, and IsoEnergy and Anfield energy part ways. The uranium spot price closed last week at $73.85, reflecting a slight increase from $73.50 the week prior. While this movement may seem minor, it highlights ongoing stability in a market still digesting the dramatic shifts of recent years. Looking back, uranium prices surged 89% in 2023, signaling a bullish trend. However, in 2024, we saw a more tempered market. Utilities, a key driver of demand, have reduced their purchasing activity, citing concerns over elevated prices, geopolitical uncertainty, and recalibrated procurement strategies. This pause has softened momentum but hasn't dampened long-term optimism. Term contracts, an indicator of future utility commitments, tell a different story. The term price began 2024 at $68 a pound and has climbed steadily to $83 a pound, marking a 25% increase. This upward trend suggests that while utilities may hesitate in the short term, their long-term demand for uranium remains robust. Importantly, these contracts are locking in higher ceilings, now surpassing $130 a pound, indicating confidence in sustained market strength. In short, the uranium market may appear muted on the surface, but beneath, the calm strategic moves are paving the way for a stronger future. Keep an eye on term contracting activity as a bellwether for where the market is heading. Kazatomprom has unveiled its 2025 to 2034 development plan while reflecting on its achievements under the previous 2018 to 2028 strategy. During the earlier plan, the company claims to have removed over 48,000 tons of uranium from primary global production, which is about 100 million pounds. To put that into perspective, it's more than double the total supply gap in the uranium sector in 2022. However, this figure represents production cuts spread across nearly a decade. While significant, Kazatomprom isn't solely responsible for addressing the supply gap, though their messaging might suggest otherwise. In reality, a variety of factors beyond Kazatomprom's control have contributed to reduced production and disrupted uranium deliveries. These include the war in Ukraine, Kazakhstan's 2022 riots that saw a government building destroyed, Niger's recent coup, and a global sulfuric acid shortage, among others. These issues, many of them unforeseeable, likely weren't accounted for in the company's 2018 to 2028 development plan. Kazatomprom also emphasized expanding its client base to 6 new countries and increasing shipments to the Americas, which rose from 16% in 2018 to 26% in 2023. This seems aimed at addressing concerns that most of its uranium will be sold to China and Russia. However, these concerns are not unfounded. Kazatomprom recently required shareholder approval for a sale to China National Nuclear Corporation because the transaction represented a significant majority of its inventory. Additionally, its major joint ventures with Russia and China mean that much of the uranium from some of the world's largest mines is destined for the East, not the West. The omission of Europe in Kazatomprom's statistics further suggests that the increased trade with the Americas may have come to Europe's expense. Kazatomprom also highlighted its development of the Trans-Caspian transport route as part of diversifying uranium shipments to the West. This shift, however, became necessary due to sanctions on Russia and the war in Ukraine, which disrupted traditional routes. Looking ahead, the 2025 to 2034 plan emphasizes a continued focus on uranium mining as Kazatomprom's core business, expansion into nuclear fuel cycle, diversification into rare earth minerals, and improved ESG and business practices. While the rare earth expansion is a new area, the rest largely aligns with Kazatomprom's ongoing trajectory. Their focus on uranium mining and the nuclear fuel cycle has always been central to their business, and their new plan mostly feels like an evolution of their existing strategies rather than a significant shift. Kazatomprom's new outlook on uranium may come with some revisionist framing of past achievements, but fundamentally it seems to be more of the same. Building on last week's report about the discovery of a supposedly ultra-large uranium deposit in China's Ordos Basin, Chinese state media recently announced that the country has identified 10 large uranium deposits over the past 3 years. This development raises eyebrows as it's the first time these discoveries have been mentioned publicly. Typically, news of such significant finds would emerge incrementally rather than being unveiled in bulk. The timing of this announcement, coming immediately after the news of the purported Ordos Basin discovery, invites scrutiny. China currently holds an impressive uranium stockpile of nearly 300 million pounds, one of the largest in the world. However, the sudden wave of announcements may indicate some underlying concerns within the Chinese government about its domestic uranium resources, or at least the perception of those resources. By highlighting these discoveries, China may be aiming to bolster confidence both domestically and internationally in its uranium supply capabilities, even as questions persist about the actual abundance of uranium in the country's discoverable reserves. This strategic messaging underscores the potential gap between China's reported uranium resources and the realities of its long-term self-sufficiency. Investors should consider whether these announcements are reflective of genuine resource expansion or more about projecting strength in a critical energy commodity. The Canadian province of Ontario has unveiled plans to construct a massive nuclear power facility near Port Hope, just east of Toronto. The proposed site, to be operated by Ontario Power Generation, would generate an astonishing 10,000 megawatts of power. For perspective, a Westinghouse AP1000 reactor, among the most advanced on the market, produces 1,000 megawatts. This means Ontario may be planning up to 10 reactors at this single location. Each reactor would require approximately 50,000 pounds of uranium annually, equating to over 0.5 percentage point of the world's current uranium demand. While this single project is significant, the broader trend it represents may be even more impactful. Ontario's ambitious plans are part of a larger wave of renewed nuclear energy interest, not just in Canada, but also in the United States and beyond. Jurisdictions like North Dakota, Connecticut, Louisiana, and New York have all recently announced plans to explore, fund, or build new nuclear plants. This growing momentum signals a shift in global energy strategy. The future is nuclear. Political leaders across the spectrum are embracing nuclear power as a solution to energy and climate challenges. However, this raises a critical question: where will the uranium to fuel these reactors come from? As discussed in today's episode, the uranium supply gap is widening, and despite optimistic claims from some quarters, such as China, this trend shows no sign of reversing anytime soon. IsoEnergy Limited and Anfield Energy have officially terminated their proposed acquisition arrangement, initially set to combine IsoEnergy's world-class uranium portfolio with Anfield's U.S.-based assets. Despite IsoEnergy's confidence in the strategic value of the transaction, Anfield's board opted to move forward independently, citing concerns about IsoEnergy's recent joint venture proposal and alternative financing options. In response, IsoEnergy emphasized its robust position as a leader in Tier 1 uranium jurisdictions. CEO Philip Williams noted, "While the Anfield acquisition would have complemented our U.S. portfolio, our existing assets position us exceptionally well to capitalize on rising uranium prices." IsoEnergy's portfolio includes Canada's Hurricane deposit, the world's highest-grade uranium resource, as well as significant projects in the U.S. and Australia. The company is advancing its flagship projects with expansion drilling underway and leveraging toll milling arrangements for rapid production readiness. For Anfield, the canceled transaction paves the way for a $26.5 million financing package, including $15 million from Uranium Energy Corp. And an $8 million U.S. extension of its credit facility with Extract Advisors. These funds will support the reactivation of the Shooter Canyon Mill, Velvet Wood mine development, and a potential U.S. stock exchange listing. Although both companies have taken separate paths, IsoEnergy remains committed to delivering long-term value through its diversified global portfolio, while Anfield focuses on its renewed strength for growth in the uranium and vanadium sectors. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.